Great, sound is fine. I'm going to share my desktop one moment, and then we're going to get going. Hope everyone's well. Great, so that desktop should be shared. We should all be able to see it. Now, I do just want to remind you guys, I am in a trading room, so I know there is sometimes some background noise. I know there's nothing I can do about that. I suppose it is, almost a live trading session, I guess, in that sense. So so just be aware that there is noise behind me. I do know that it's there, but there's nothing I can do about that, unfortunately. So let's take a look at our disclosures to kick things off here. This presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products may involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, are not available for US residents due to regulatory reasons. Okay, guys, let's get started. Just bear with me one moment. I had to reload my charts just before I got here. So we'll just bring them up. Then I can bring that down. And look, there we're ready to go. I'm hoping everyone can see my chart right now. This is a cable. It's a long-term cable on a daily chart. But it just look. I was looking at this yesterday. I sent out a piece yesterday just about how kind of weak this pair was looking, really. And as you can see, it is looking quite weak. As you can see, it's, this is the green line here is the 50-day moving average. Even though we have actually kind of bounced a little bit higher today, that comes on the back of some weakness in euro sterling, which I'll look at shortly. We're still getting thwarted at that 50-day moving average. Now, today could be a day of very short, tight ranges, not just for cable, but for quite a lot of stuff, largely because there isn't as much key economic data coming in today as there is from others. Now, some people can look at that in two ways, I suppose. Number one, that means that maybe we're not going to see as much what's going on. But then on the other hand, maybe we will. Maybe people will start pricing in, the major events that are coming on. So that's kind of important to look at from that angle, I suppose. So here, as you can see, cable, it's not looking completely weak yet, but it's certainly not looking good either. Now, I want to draw in another fib retracement from here to here. A lot of people are looking at this level now. Let me just move the chart a bit. This kind of 166.66 level, all the sixes, doesn't sound good, does it? It may not be good for cable bulls, but that is a 61.8% retracement of the March to May advance, and if we get below there, that's going to be quite a bearish development for cable. Right now, we've managed to stay above it. We have dipped below that 50%, which comes in at 167.29, but we've still managed to stay above it, as I mentioned, but yet we are being thwarted again at that 50-day, and that comes in around about, I think it's 167.71. Let me just double check that with my other chart, just to be sure. Yeah, sorry, 167.79. So that's acting as resistance right now. 167.29 acted as good support, certainly earlier this week. And then we think that with 61.8% retracement of that March to May advance is your key level of support, really. And if we get below there, that would be a very negative development that could set off a lot of bearish momentum. And we could see, potentially back to those March lows. So just watch that one. Certainly a level worth keeping an eye on. Cable this week, we think, could be dictated not by what goes on in the UK. We think the Bank of England meeting is going to be a bit of a non-event. We don't think people will be too interested in it. Instead, what we think is that people are going to focus on maybe the US side of the cable pair, and that suggests that maybe we have to wait until we get other data that comes out of the US, and obviously that payrolls report on Friday. That's going to be absolutely critical. Merck C, you're saying dollar strength on the horizon. Interesting that you said that. Obviously, I've just picked that up here with cable. The potential, if we do get back down to this 166.66 level, will be on the back of dollar strength. Let's take a look at the dollar index. Last week I mentioned to you that the dollar index was showing signs that it was starting to turn. We then got a very bullish development on Friday, and that was when this is the dollar index, by the way, so it's the dollar against the US's major trading partners. A really good way to look at the dollar on a broad kind of spectrum, I guess. And as you can see here, it's broken above that 200-day moving average. We've tried to break above there before, failed, and we've done it with aplomb, really. We had another very strong move yesterday. Now, some of you may have been trading the markets yesterday, I'm not sure. Gregory, I think you just asked me a rather personal question there, so I won't mention about that. Basically yesterday, some of you will have been trading the markets, and it was essentially, we saw the ISM manufacturing come up at 3 o'clock as normal, and everyone was like, okay, fine, weaker than expected. But yet we then got 2 further revisions. So one up to 56, which was better than expected. So all of a sudden the market, the ISM was saying, oh yes, no, we made a mistake. This was good, a good message. It was a good development, and then it was actually revised down a little bit after that. So a real mess up on the part of the ISM. But anyway, the dollar index, they ran with the good news, and that was it. Personal message, it was actually about my wages, so I'm not going to answer that one, I'm afraid. But please do, if you do want to ask a question, very happy to answer any question about the market, but just let's keep it to the market, shall we? So as you can see here, we're still above the 200-day moving average. 81 is still on the horizon. And then we're looking at those those Feb highs, which come in around about 81.40. So we're not too far away from that now. We're only about, well, we're less really, that we're 90 pips away. However, because the dollar's been trading in such a range, that could take us a while to get to. So I wouldn't necessarily say that we are, moving. I wouldn't necessarily say that we are moving into a new trend. We're not. You can tell this with the dollar. So this is going back to Merck's question, that the dollar is, that we are, are we seeing some dollar strength? Yes, we are. But we are approaching the top of the recent range, or the long-term range, I should say, going all the way back to November. So that doesn't necessarily say that we're going to see continued, dollar strength. There could certainly be another 100 pips of it. But where we go from there, whether or not we kind of extend above there, it will all depend how we react around about that 81.5 level, which is the high from here and here. 3 times over the last, how long? 6 months, we have bounced back from it. So we have rejected resistance at that level. That's the key thing. Okay, so that's kind of an important thing. Pan, are you talking about the ISM? Does anyone know for sure? I believe that the final reading was put out yesterday after the London close. So that's worth watching there. Is yen going to strengthen versus the dollar or weaken? Well, funny you should say that, because I have been looking at here we go. Looking quite closely at the yen. And this is, oh, sorry, that was my fault. Didn't mean to do that. Meant dollar strength in general, REUSD. I think the market is very uncertain right now, but I do think the dollar is strengthening. But again, it's strengthening. It's towards the top of its range. It's not breaking into a new uptrend. That's basically what I'm trying to say. The Nikkei is the white line on this chart, and dollar yen is the orange line. As you can see, if you just cast your mind back to the left-hand side of this chart, so this area here, the Nikkei and dollar index and the dollar yen tend to move really, really closely together. They have lost a little bit of that closeness. They have lost a little bit of that closeness, but they are coming back together. So yesterday we saw a massive increase in the Nikkei. It was, one of the it was best performing index in the G10 by a mile. It's had a fantastic run of late. It was up more than 2%. That compares very favorably to the eking out tiny gains that we're getting elsewhere. Even in the US, where they made fresh record highs yesterday, it's only up by like 0.2, 0.3%. That has helped, we think, to put an upward pressure, or could potentially help to keep upward pressure on the dollar yen. So as you can see, dollar yen here, the Nikkei helping, they're kind of moving back in the same direction. If we see further gains in the Nikkei, it's hard to know. It's a chicken and egg situation. It is a chicken and egg situation whereby on the one hand we have does the Nikkei lead dollar yen, or is it the other way around? I mean, who knows? Some people could say, well, actually, corporate strength in the Japan should be what leads, maybe that, weakens the yen, or maybe they need a weak yen before they can make the corporate profits. Who knows? There you go. Anyway, that relationship is there, and it has been in place for the last 12 months. You can see that. So if we do continue to see these kind of outsized gains to the Nikkei, watch dollar yen. That's certainly something that we would look at. Now, looking at dollar yen, we did mention yesterday, for those of you who follow our notes, that there could be further upside of dollar yen, and indeed there was. Let's take a look at that. We're now testing the 100-day moving average, which comes in at 102.37. We're actually above it for now, but we need to get a kind of daily close above there. That would be quite a bullish development, certainly in the short term, because it would suggest that we've got over our nearest hurdle. We've got above as well. Certainly broke out of those highs from earlier in May, from about the 13th of May. But we do still we then could potentially run into some resistance around about that 103.20 level. We did spike up there at the very beginning of May. As you can see, this kind of, you might be able to see it here, just where my crosshairs are. That was from the 2nd of May. Actually, let me just zoom in a bit here and we can, that 103.20 level is your next major level of support. 103 I think we got to 103.20. That's your next level of key resistance in dollar yen. So do watch out for that. Again, as you can see, when we've got a very enlarged chart, we've had a really nice push higher. And if we could stay above that 100-day, that would be very, very, very supportive there. So again, the dollar yen is almost a bit like the dollar index, in the sense that we're moving in a bit, we're in a position whereby we're kind of moving in line, really. We're moving in a quite tight range, and right now we look at like we're at the top of that range. Whether or not we can break out, that would be a good thing. Certainly these levels, it's worth watching. It's worth watching to see how dollar yen performs over the next 50 pips. If we can get back above those 2nd of May highs, that's going to be really, really significant. Now, earlier today, we had a raft of data out of the Eurozone. It was a mixed bag, actually. We had weaker inflation, and then we had a better reading in unemployment. But as you can see, still clinging to that 136 level. We have got down to that 135.89 level, but we are still clinging to 136. 136.45, that is the 200-day moving average. That is your next level of major resistance. Now, obviously, we've got a big ECB meeting coming up on Thursday. The market fully expects the ECB to do something, so to cut interest rates, deposit rates, and also to maybe implement some measures to spur bank lending in the small business sector. If that happens, as we expect it to be, we could end up seeing a bit of what we could be seeing right now is selling the rumor and then buying the fact. Take a look at this. This was the last ECB meeting back in May. We spiked higher to 140, and then since then we've pretty much lost 400 pips. That's an awful big move for 10 to 15 basis point cut in the benchmark of the deposit interest rate. I know that would push the deposit rate into negative territory, but for plenty of reasons, I still don't think that's actually going to be enough or going to work from the ECB. So, in many ways, we could have actually priced in what the ECB is going to do. And so we could trade sideways a little bit for now, and then potentially go back to, having to wait to hear from Draghi what he says. If he doesn't say anything, if he doesn't say enough, obviously, if they don't do anything, I'd expect a massive rebound in the euro. You could easily see us 200, 300 pips higher. But, however, if he does announce, if he does, do as the market expects, then the market will expect him to do more, and maybe signal to doing more easing going forward. If that's just kind of a very, low or very, vague sentiment to do something else, then we could actually just kind of trade sideways a little bit. I think that's certainly something to point out. Some people, they say, oh, the minute you've changed the trend, then the trends don't move in a straight line. Let me tell you that. We can see that from here. We've had very large periods where we've moved sideways. We could be in that period of moving sideways right now. It'll be interesting to see how the market interprets what the ECB does, and whether or not they can interpret it and see it as boosting the economy, or maybe this is just the start of something more deep. Maybe they'll do QE. I very much doubt it, and so we are kind of expecting maybe certainly some in the short term anyway, certainly as we lead up to this meeting, a bit more nervousness, a bit more kind of range trading. It looks like 135.80-ish is on the down, is supporting the downside, with 136.5, that 200-day moving average, on the upside. Someone's asked me a really interesting question about the EU and the future of the EU now that Eurosceptics have won. We kind of think that Eurosceptics, the Eurosceptic parties, they have the EU will survive because the Eurosceptics didn't do enough to damage power in Brussels, but they've done enough to hurt power at home domestically. It will be interesting. A lot of people, the latest polls have said that maybe, support for some of the more extreme parties has actually calmed down, has actually moderated, even since those EU elections just 2 weeks ago. So it'll be interesting to see how they do act, how they do react. There isn't an immediate risk anywhere really for these Eurosceptic parties to disrupt domestic policies. There's no election scheduled for France. Obviously, the UK is next year, so that could be one worth watching. But it does look like the Tories have done very, very well in the Newark by-election, which was a key test for them. So I think there's going to be more status quo in the UK over the next 5 years. Then we've also got, of course, Greece, with the Syriza party having done very well. But right now, they're not calling for to topple the government and fresh elections. Now, they may do. So I think Greece is actually the weak spot here. Just to show you how the markets don't seem to matter, or certainly turned a blind eye to those wins for some of the less mainstream parties in the US. These are in the EU, sorry. These are the Spanish bond yields. Since that election, when yields were above 3%, they have moderated and they are back to record lows. So that to me is, is a clear sign that the market is just shrugging off political risk, doesn't see it as being a big threat. Instead, obviously, you would expect yields to moderate on the back of, or ahead of, ECB price action. But then this also suggests that maybe yields have been moderating for a year nearly. So, maybe this is QE. Maybe this is what QE looks like. That yields in Spain and elsewhere, they've fallen so low to multi-year lows that actually there isn't that much else that they can do, really. This week, can we expect 135.65? That's Manny. Manny, let's just go back to Euro and we'll take a quick look. There is downside potential for sure. 135.62 is the February low. So that's the low from... That's February 12th low. So that's coming up where? Around about here. This low is certainly on the horizon for sure. That overall February low from February 3rd at 134.77 is still on the horizon as well. What I kind of meant is that potentially it's not going to be there right now. Doesn't mean that we're not going to get there. Bearish conditions very much firmly in place. Basically, if we break below, it's probably a matter of time before we get to these 134.77 lows. If we break below there, then you kind of open the way to 132.5. We've got kind of MACD, that's bearish. We've also got, some stochastic momentum indicators there suggesting that there's limited upside. We've got the fundamental backdrop is very, with the ECB taking action, very weak. Inflation data that would all suggest that maybe the euro should fall lower. I'm just saying it's pausing for breath a little bit, because what we do know, Manny, is that they could sell the rumor, buy the fact. So actually, I think any move back to this 200-day here at 136.46 could actually be used as a bit of a selling opportunity. So rather than selling, at the lows, sub 136, people may wait and sell as we move towards 136.5. So I think there is a good chance we'll get to those Feb lows. I think there's a good chance we'll get to those early February lows as well at 134.77. I just think right now we're pausing for breath, and for an obvious reason. There's been a lot of negativity priced into the euro already. Merxy, what do we know about yields? Well, as I said, yields in Europe are very low. That's what we know about yields. Yields globally are very low. Let's take a look at treasury yields, the most important yield out there, some would argue. Treasury yields fell to 2.4%. All of a sudden, a ton of investment banks came out and said that they expect yields that to be the low in yields. Well, at the moment, it does seem like they're right. They were helped by that upward revision to the ISM survey. And we are now we're up 16 basis points from those lows at 2.4%. That's also helping dollar yen to move. 2.63 is the 50-day moving average. That's the highest level from mid-May. And that's the next level to watch. Someone's asked me about the situation in Fukushima in Japan. I actually don't know too much about it. I'm sorry. I know obviously that's where there was the nuclear reaction, but Maxie, I think what you're saying, where do we know about it? So where can you read about yields? It's very difficult, I know, for retail traders to get detail on yields and to get data on yields. You can check our research, we write about it. Otherwise, a lot of the papers, the FT, for example, write about yields quite a lot. What's my opinion on the Aussie, especially since iron ore prices are low? Again, I'm not too enthused by the Aussie. The Aussie is today, it's one of the better performers in the G10, but again, it's quite a tiny move. So for me, we're still moving, I've only got a short-term view on it. I don't have a long-term view on the Aussie PAN, but what I do have is I do think that those lows above 92 are protected. Below there is 200 and 100-day moving averages. Tomorrow is going to be a big day. We're going to have that service set to PMI data out of China. Today, we did see some slightly weaker than expected PMI data out of China. The HSBC reading of the manufacturing report. It didn't have an impact, though, and Aussie was higher. But I think that's probably just going to kind of, on the back of the RBA remaining on hold, even though they didn't say anything new. And then we also have, had quite a large down move yesterday. But as you can see, tiny little candles, not too much momentum one way or the other. It's stable, the euro, the Aussie right now, I would say. It's moving sideways. That uptrend that we saw from January seems to have stalled for now. But as I said, uptrends don't always go in a straight line. Whether or not that move above 94 that we saw in April is going to be the top for now, we'll have to wait and see. It certainly is at the moment. We are, it's going to certainly be an interesting one. I think it's stable. I don't think it's moving one way or the other. I probably, if you want to get involved, I'd get involved on a very short-term basis. 93.04, that was a high we got above that high yesterday. 50-day moving average. We've been testing it, but not able to break out of it. In the short term, if we test it again, then maybe it suggests that there is some buying interest. But again, as I said, I think at that point, 94 would come in and potentially, whack it down. Sorry, Merck. What you're saying is, how do you read yields? So basically, if yields are low, well, it depends, right? So in the US, you don't have a debt problem. You've got, yields that were very, very low. That weighed on the dollar. Let me bring up a chart for you and I'll show you that. The magic of Bloomberg here. Bear with me, guys. I'll just do this very, very quickly. As you can see, when yields are high, that can correspond with highs in a currency. When yields are low, that can correspond with lows in the currency. It doesn't work all the time. But as we've seen, so the orange line in this chart, by the way, are treasury yields, and then we've got the dollar index in white. When treasury yields were trending lower, we also saw a bit of weakness, certainly, in the dollar. But then the dollar actually started rising as yields started falling last week. And that meant to me something was out of whack. Pan, I'll answer your question in one moment. And that meant to me something was generally out of whack. And indeed we did. We saw treasury yields move higher yesterday and on Friday on the back alongside the dollar moving higher. So what tends to be when you've got, no debt crisis in the country, if yields are low, that can weigh on a currency. And if yields move higher, that can help currency strength. That doesn't always happen. For example, the UK yields were very, very low, but it still did very well against the euro. That's because gilts in the UK were attracting safe haven flows during the Eurozone crisis. It's quite complicated. Likewise, in Eurozone, because there was a debt crisis and yields were very high, when yields were very high in the periphery of Europe, that was what weighed on the euro. So actually what we've seen is a negative correlation between peripheral bond yields in Europe and the euro. So you've seen Spanish bond yields fall since July last year. At the same time, you've seen the euro do quite well. So it's not a unifying theme of how bond yields react to markets. So sorry about that, guys. You've just got to kind of listen to it one by one. You were talking about you're going back to the Aussie pan iron ore, generally key determinant. Iron ore does matter. Let me just pull up an iron ore price. Iron ore, obviously it does matter because it's a big export mineral, I suppose, for the Aussie. So again, as you can see, it's not got a perfect relationship in any way with what the Aussie is doing, but it's one key contributor. So when the Australia is an exporting nation, when its main export market is weak, China, added to that, the stuff that you're exporting is falling in price, that can hurt your terms of trade and that can hurt the currency. That's how it works. So yes, while iron ore is so weak, if we were going to be in a long period now, if the commodity boom is over and we're in a long period of potentially current commodity malaise, that one would think that could limit Aussie upside, at least until they are able to turn their economy around and make it more domestic demand focused.